the ETF applications. There are already 155 crypto ETFs that follow 35 different digital assets. That's not a coincidence. It's a land grab. This is Wall Street's version of the California gold rush. But this time, the gold is digital. Bitcoin and Ethereum are at the top. Institutional investors are putting XRP Solana and even newer initiatives like Chainlink into structured investment instruments. Why now? Once the Fed accepted distributed ledger technology into its own system, it was evident to institutions what to do. The gate is open for building. You can almost feel the capital rotation going silently under the headlines. Every time a new ETF filing comes out, it gives pension funds, sovereign wealth funds, and endowments another way to legally, safely, and out of scale enter the crypto market. This is the way to get into the next bull cycle. And it's not retail that is pushing it. It's the same money that used to control real estate, oil, and bonds. But while crypto wins its ticket to the big leagues, gold recently had one of the biggest crashes in modern history. Gone is $1.7 trillion in value. It appears like panic selling to people who don't know how to trade. But if you look at liquidity flows, you'll notice something else and more. Liquidity is always there. It moves. It rushes toward the next basin of opportunity, just like water flows out of a broken dam. And right now, that basin is in the digital world. It's incredibly poetic. For hundreds of years, gold has been a symbol of wealth and stability. The blockchain is taking the place of bullion in the same manner that the telegraph took the place of the horse. When the Medici family devised double-entry bookkeeping in the 15th century, they didn't just change accounting, they also made trade easier to scale. It was a change in technology that looked like a financial tool. The change today is the same. The ledger is the only thing that isn't written in ink. It is written in code. And the banks that used to keep gold bars in vaults are now buying back tokens that are backed by blockchain technology. That's the truth behind the 1.7 trillion. The Federal Reserve just set off a financial bomb that is affecting markets all across the world. It is said that 55 crypto ETFs are in the works. There are trillions of dollars moving. And gold, the oldest form of money in the world, recently saw $1.7 trillion disappear into thin air. You would assume that's a coincidence, but it's not. This is the start of a monetary reset that is being done discreetly, carefully, and with great care. Today, we're going to talk about the real story behind the crypto ETF tsunami, what the Fed's new position is, what it means, how it relates to Ripple, BlackRock, and the global liquidity corridors, and why this could be the point at which crypto goes from being a speculative investment to becoming a part of infrastructure. This isn't simply another headline from the Fed, so don't get me wrong. This is the go-ahead from the government that crypto has been waiting for. Let's go back to a time that most investors missed. The Federal Reserve held a small, quiet conference on payments innovation. The Fed and the crypto sector have been enemies for a long time. Two systems that don't trust each other. But this time, the tone was different. Officials from the Federal Reserve didn't say anything about making crypto illegal. They said they wanted to construct with it. It was erroneous for Fed governors to state, distributed ledgers and tokenized assets are no longer on the fringes. They are now a part of modern finance. That one line hidden in the transcript is the turning point. The Fed has been looking into tokenization, trying out smart contracts, and even testing blockchain-based settlements in its own systems behind closed doors. Think about it. The same organizations that used to warn about how unstable cryptocurrencies are now looking into how DeFi infrastructure can update its own payment systems. And here's the best part. This isn't just a theory anymore. They're building a so-called skinny account system with limited access to offer crypto and fintech companies direct access to the Fed's payment rails. No more intermediaries, and you don't have to rely on old banks to clear blockchain transactions anymore. This is like the Fed opening its vault doors and saying, come on in. At the same time, something else quietly blew up, collapse that no one wants to talk about. Not destruction, just a change of direction. We've watched this movie before. The Bretton Woods Accord tied all currencies to gold in 1944. Nixon cut the knot in 1971, starting the fiat age. When the infrastructure below it becomes old, the era comes to an end. The code standard is starting to come out now, 50 years later. A world where value moves at the speed of light, not by vaults, but by cryptography. The Federal Reserve, which used to print the notes that replaced gold, is now getting ready to keep an eye on digital liquidity. There isn't just one currency in the world. It's a one-world system, a framework that allows stable coins, central bank digital currencies, and crypto assets to all work together on the same rails. That's what the Fed's seminar on new ideas truly meant. A link between the analog and the algorithmic. Let's have a look at the numbers. Bloomberg analysts who keep track of ETF filings say that if approvals start coming in, the digital asset market may see more than $500 billion in new money in the next 12 months. BlackRock, Fidelity, and UNESCO are not changing their positions. They're buying infrastructure firms, working with tokenization platforms, and teaming up with networks like Ripple that already have clear rules from the government. Even central banks in Europe are discreetly working on cross-border settlement pilots that use distributed ledgers. The ECB's digital euro sandbox, the BIS project icebreaker, and yes, the Fed's own FedNow integration testing with tokenized liquidity providers. These are all parts of the same picture, the Internet of Value coming to life. In contemporary history, every big change in the economy has also meant a change in who is in charge. From the Medici ledgers to the British gold empire to the American dollar's domination, those who controlled settlement, not currency itself, ruled the economy. That layer of settlement is now shifting to the blockchain. And whomever controls liquidity routing, the plumbing of this new system, will be in charge of money for the next 100 years. That's why corridor builders like Ripple, Circle, and others are important. They aren't chasing after speculation. They're putting the rails together. The same way Swift used messaging to connect banks, DT is now using automation to connect assets. The Fed's shocking news means that the new infrastructure isn't arriving anytime soon. It's here. Let's be honest now. Not every headline is good news. When this kind of change happens, there is always going to be instability, manipulation, and false information. A lot of retail investors are still losing money, trading on margin, using leverage, and pump and dump cycles. While institutions build up, influencers make risk seem glamorous. History repeats itself. Most miners lost all their money during the California gold rush. Those who developed the railroads, banks, and supply systems got rich. Protocols, tokenization, networks, and liquidity providers that are similar to those used today. Not the people who ride the rails, but the people who build them. So, while this wave of ETFs rolls in, keep in mind that you shouldn't follow the waves. Instead, develop where the tide is flowing. Think about the next 5 years. The Fed doesn't print money in the usual way anymore. It makes liquidity into tokens. Smart contracts take the place of interbank clearing. BCs talk to private stablecoins through corridors that work with both. Gold is still a relic of the past, respected but not used much, and crypto is no longer a gamble. It's the system that runs trade around the world. This is where we're going. Not right away, but it will happen. Every mistake starts out as a heretic and ends up as a heritage, just like how electricity replaced candles and email replaced letters. Crypto is currently going over that line. So, what does all of this mean for you, the investor who is watching this right now? It signifies that the time of being alone is over. Crypto is no longer the odd one out. It's the way things are set up. But with that legitimacy comes the need to consolidate. The days of the Wild West are coming to an end. The next chapter will be about regulation, standardization, and institutional custody. That's why cold storage and keeping things safe are more important than ever. If 2025 is the year that institutions get involved, then 2026 will be the year that they take over. And the only way to keep your freedom in a programmable economy is to keep your own keys.